Hello everyone! Today, we're going to discuss about the partnership liquidation. This is the continuation of our video lectures about partnership accounting. Again, this is Sir Albert Cruz, your course facilitator. Liquidation is the termination of business operations or the winding up of affairs. It is a process by which assets are converted into cash, liabilities are settled, and any remaining amount is distributed to the partners. Liquidation may be either voluntary, in which it is based on the agreement of a solvent partnership, or involuntary, as a result of bankruptcy. The available cash of the partnership is used to settle the claims in the following order of priority. So first, we have to pay our outside creditors. And then secondly, the inside creditors. So these are the partners with claims from the partners in their capacity as the creditors. And then lastly, the partners' capital balances. As shown above, a loan payable to a partner has a higher priority over the partner's capital balance. However, the legal right to offset allows a deficit in a partner's capital account to be offset by a loan payable to that partner. Liquidation may be accomplished either through lump sum liquidation, number 1, wherein all the non-cash assets of the partnership are sold simultaneously or within a very short period of time, and the proceeds are used to settle first all the liabilities, and any remaining amount is paid to partners under a lump sum payment or a one-time or single payment. It is possible when there is a contacted buyer of all the non-cash assets, or the assets are sold on a package deal basis. In most cases, it would take some time before all the assets of a business are converted into cash. In such a case, the partner's claims are settled on an installment basis as cash becomes available, but only after all the partnership liabilities are fully settled. The formula to determine the amount to be received by each partner under lump sum liquidation is as follows. So the starting point is the adjusted capital balance or interest. This amount pertains to the capital balances after effecting the partners' respective loans and advances, as well as the net income earned or net loss incurred by the partnership prior to liquidation. Next, we add or deduct the gain or loss on realization, as well as the liquidation expenses incurred. In most cases, these two items are combined. Then the bottom figure represents the remaining interest. To compute for the gain or loss on realization, we have to determine the proceeds or cash from the sale of non-cash assets and deduct the book value of these non-cash assets. The net amount will be your gain or loss on realization. As to the remaining interest, if this turned out to be positive, then that will be the amount to be received by the partner. However, if the remaining interest of one or more partners turned out to be negative, then the following must be applied. If the partner with negative balance is solvent, meaning his personal assets are greater than his personal liabilities, then the deficiency must be eliminated by investing additional cash. On the other hand, if the partner with negative balance is insolvent, so his personal liabilities exceed his personal assets, then the deficiency must be absorbed by other solvent partners or those with positive remaining interest. Okay, so to illustrate partnership lump sum liquidation, let's answer the following problems. First, Problem 1. A, B, C, and D are partners of a very successful auditing firm. However, due to disagreements in managing the firm, they decided to liquidate. The statement of financial position just before liquidation reports the following balances. Additional information: cash was distributed whenever available. All personal liabilities of each partner exceeded their respective personal assets. So it means all partners are insolvent. Other assets were sold for 560,000 net of all expenditures paid to consummate the disposal. So the gain or loss on realization as well as the liquidation expenses are combined. Okay, so to begin, let's determine the capital balances or interest prior to liquidation. So we have here 200,000, 160,000, 180, and lastly 150,000. Okay, so the total amounted to 200 plus 160 plus 180 plus 150. Okay, so that is 690,000. Okay, so these are the capital balances, or we can say that these are your partner's interest. Okay, so no loans and advances, no revaluation, and also the net income or net loss may have been probably close to the capital accounts of these partners. So the next thing that we have to do is to determine the gain or loss on realization. Okay, and then for liquidation expenses, okay, combined. So no need to determine that. So all we have to do is to determine the gain or loss on realization. And to determine that, okay, so we have to know the proceeds or the cash received from sale of non-cash assets. So this is your 560,000. And then deduct the book value of these non-cash assets. So we have 800,000. So less 800,000. So book value is greater than the proceeds. Therefore, we have loss on realization amounting to 240,000. This 240,000 will be distributed to the partners. Okay, so in the ratio of 2:2 3:3. So 2, 2, 3, and 3. So 240,000 times 20%, so that is 48,000. Okay, another 48,000. And then for 30%, okay, so let's see, 240 times 30%, okay, we have 72,000. And then we determine the remaining interest. So for this one, 152,000, and then 112. For partner C, 108. And lastly, for partner D, 78,000. Okay, so the difference is 450,000. Okay, so as you can see, all of these are in positive amounts. So if these are positive, if the remaining interest of the partners are positive after deducting or adding the gain or loss on realization, then this should be the amounts to be received by all partners. So that's for problem number 1. How about problem number 2? So let's see. For problem number 2, W, X, Y, and Z are partners. However, due to disagreements in managing the firm, they decided to liquidate. The statement of financial position just before liquidation reports the following balances. So additional information, cash was distributed whenever available. Only partner W is insolvent, the rest of the partners are all solvent. Other assets were sold for 560 net of all expenditures paid to consummate the disposal. So compute for the amount to be received by each partner. So similar, W, X, Y, and Z. Okay, and then total. So let's determine first their capital balances or interest. So we have 50,000, 60,000, 280,000, and lastly 300,000. So if we get the total, this would be 690,000. Okay, next. So again, plus or minus, gain or loss on realization. Okay, since we have the same amount, 800,000 and 560. So 560 minus 800,000, that will give us a loss of 240,000. Okay, now let's distribute this 240,000 to the partners. But okay, kindly check the ratio, profit or loss ratio. So 3 is to 3 is to 2 is to 2. 240,000 times 30%, okay, that is 72,000. 72,000. And then 240 times 20%, that is 48,000. Okay, so less 48, less 48,000. And then we get the remaining interest. So this will be the remaining interest after the gain or loss on realization. So definitely this one has a negative balance in the amount of 22. And then for partner X, negative also, negative 12,000. For partner Y, so we have a positive amount. So this is 232,000. For partner Z, 252,000. So again, we have 450,000 for the total remaining interest. Okay, so now we have negative balances. Okay, as a rule, as we have discussed previously, if the partner has a negative balance, okay, so the action that would be done would depend whether the partner is solvent or insolvent. So if he is insolvent, it will be absorbed by other partners who are solvent or those with positive balances. Okay, of course, if you are solvent, solvent partner with negative balance, so all he has to do is to invest additional cash to make up for his deficit. Okay, so in this problem, only partner W is insolvent, the rest are solvent. Okay, so this 22,000, to eliminate the deficiency, this will be absorbed by partners X, Y, and Z. And why? Why is that all of these other partners, including partner X, who has a negative balance, shall absorb 22,000? Because as a rule, all partners who are solvent, okay, all of them are solvent partners, and also some of them are Y and Z are positive balance. So both partners Y and Z are both solvent and positive. So the more they need to, or they have to absorb the losses from partner W, who is currently insolvent. So basically, all you have to do for the partner to absorb the deficiency is to check whether they are solvent or positive. So it means if they are solvent, although they have a negative balance, they still need to absorb from the losses. If they have positive balance but they are insolvent, they still need to absorb up to their positive balances. Okay, so in short, X, Y, and Z shall absorb 22,000. Okay, So our reference or our basis would be the profit and loss ratio. So 3:2:2. So 22,000 times 3/7. Okay, so 9,000, let's just round off to the nearest whole number, 9,429. Okay, and then 2/7 times 22,000, so that is 6,286. Okay, so 2,000, 6,286, and lastly, for this one, another 6,286. Actually, there is difference of 1 peso, no? Anyway, so let's just make this 9428 to make this exact. Okay, so this will be 0, of course. So absorption of loss. So this will now be 0. So the deficiency has now been absorbed and eliminated. And then for partner X, his deficiency has increased to 21,428. Okay, for partner Y and Z, so 232,000 less 6,286, so that is 225,714. While for partner Z, we have 252,000 less 6,286. So this is 245,714. Of course, the total should be 450,000. Now, there's still negative balance. So we are not going to stop unless or until all balances become positive. So for this one, partner X, since he is solvent, he has to make up for his deficit by investing additional amount. So investing additional cash, or rather contributing additional cash. Okay, so this will be 21,428. Of course, this will affect the total partnership capital, 21,428. So now for partner X, W rather, 0 again, and then for partner X, 0 after his investment. And then let's just bring this down, 225,714, and lastly 245,714. Okay, for the total is this is 471,428. So now all of these balances are now positive, and therefore this will be the distribution to partners. So the answers would be, for partner W, will no longer receive cash, as well as partner X, but partner Y will receive a total of 225,714, while partner Z will receive a total of 245,714 for their settlement. Okay, so that's it for partnership lump sum liquidation.